Hello, everyone. Today on the final bar, my guest is Guy Cerundolo from Cerundolo Investment Research, joining us from Boston, giving us a big picture view about how to think about the overall market environment, not just on equities, but also in the commodity space. We've talked about that pullback in gold, precious metals. We'll see what's in store for us there. The S&P continuing in that 3,200 to 3,400 range, teasing the upper end of it. Not enough follow through today, but we're in the upper end. We'll see what's next. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for our show as we break down the activity in the markets using the lenses of technical analysis, behavioral finance, quantitative methods, anything we can do to try to make sense of the volatility, the uncertainty in the markets. You know, when you think about uncertainty, which is, I think, what's defined the recent history of the markets, today is sort of a great microcosm of that uncertainty. Plenty of movement, plenty of volatility, sort of a gap up at the open, a lot of choppiness, no real directional movement. Although if you look under the hood, even though the S&P, again, up 0.5%, sort of, teasing the upper end of the range, but not really following through the course of the day, there were sectors that did quite well, with real estate leading the way, higher, up over 1.5% or 1.5%. On the downside, you have energy on the same day down 3%. So there are plenty of opportunities. There are stocks making new highs, stocks making new lows. It's all about a question of identifying those opportunities. Now, we have some wonderful guests to help us along the way. I mentioned Guy Cerundolo is joining us in a little while, which it'd be great to get his take on things. Next week, we have three really good guests for you. On Tuesday, Jay Hatfield from Infrastructure Capital Advisors in New York. On Wednesday, Willie Delwich joining us from the Milwaukee area with Robert W. Baird. And then on Thursday, J.C. Peretz from All-Star Charts joining us back on the show again. So three pretty talented strategists, investors to share some of their collective wisdom with all of us. Looking at our market recap, we've had, again, we've had this situation where the S&P stocks rally into a high in early September. They come sort of back down to earth, and now, bouncing off of a swing low just above 3,200. And now the question is, what's next? And looking at a daily chart of the S&P, we've been focusing on this range, sort of this 3,200 to 3,400 range, which is sort of where we've now bounced between. The 50-day moving average was one of the first, really key levels to be broken after we broke down through 30, sort of this 3350-ish level. We hit the 50-day moving average, broke down through it. We, at this point, have made a lower low into that support area that we've been talking about for a while, which is the swing high from June, the swing low from late July, and that's sort of lining up pretty well with the low we saw about a week and a half ago. Since then, we've now broken up through trendline resistance. We've broken back above the 50-day. We've closed above it again now for the second day. And the question is, do we have enough gas in the tank to propel us above 3,400, above these previous swing highs, which I would argue would clear the way back to 3,600, if not higher, going into year end. If we're able to get back above there, that tells you that this was most likely a short-term pullback and that things are doing well. And again, remember the context of what's happening here. We're going to look at a little bit at new highs. We're going to look about the fact that groups like homebuilders are making, as a group, new 52-week highs. So there are stocks that are emerging and following through to the upside for sure. Having said that, there are also stocks that are not able to do that. And energy, financials, these are some of the groups that, or some of the sectors that have certainly been on the, struggling more than others. And those are the types of weighing. Those are the groups that weigh on the S&P and prevent the index from getting materially higher potentially. Healthcare, there's many others, not just those particular sectors. And so right now we're in this push and pull within this range. And the question I think remains, do we follow through to the upside, break above 3,400? Do we retest these swing lows and break below there? Now we can chop around here for quite a while in that third direction of sideways. It's not up, it's not down, it's more sideways. That can be the most frustrating trend for everyone. unless you're an options investor and betting on low volatility. Other than that, you're probably frustrated we don't have some sort of directional movement. So those are the sort of barriers I think we're in. I think those are the levels that we want to pay attention to. Now, having said that, there are a lot of tools we can start to try to use to make sense of things. First off is looking at confirmation with other asset classes, other cap tiers, other styles. Worth noting today, small and mid caps actually did very well. So while the S&P kind of chopped around and spent most of the day in a similar range, small caps actually pushed to the upside. Mid caps actually finished at the highs of the day. So sort of the smaller mid cap space actually did quite well. The Nasdaq 100 also up almost 1.5%, while the S&P was only up about a third of that. So you did see some leadership in particular spaces for sure. Looking very quickly at some other asset classes, bonds essentially flat. They opened lower, traded higher, and finished essentially flat for the day. So no real change there. Gold and silver actually finished more strongly. Gold had a pretty decent day, up almost 1%. Silver up about 2% at the same time. We talked about a daily chart of the S&P, so let's get to some of the sector themes. Interesting to note, real estate leading the way today. So on a day when the market actually held up pretty well, pushing higher toward 3,400, the real estate sector is number one, which is not what you would normally expect. It's more of a defensive, sort of high dividend, income-oriented sector. But I actually did a webcast earlier today, recorded one with the CMT Association, talking about the CMT exams. And one of the examples we looked at was 2014, which is the middle of this big cyclical bull market. And the number one sector in an up year in the middle of that range was utilities, which doesn't make a ton of sense. You think of utilities as more defensive, but the point of that example is similar to what you see on a day like today. Just because even if you know the market's going to be up, you can't necessarily make assumptions about what sectors, what particular stocks may or may not do well. It behooves you to actually look at the charts and focus on where the opportunities are. So a sector like this doing well deserves your attention, whether or not it's traditionally offensive or a defense. So at the top of the list, real estate, communication services, consumer discretionary, technology. So those next three certainly are what I would consider more of the offense of the day and leading the way higher. On the downside, energy having the toughest day of the 11 sectors, followed by materials, followed by healthcare. And these last couple here, materials is an interesting one because industrials and materials really emerged in a position of strength. And when you look at the XLB, it hasn't necessarily been able to follow through on a relative basis. Looked really good as the market topped out in September. Materials actually made a new high while the market was coming off. We saw the relative strength spike, but since then, really in the last 2 weeks, you've seen materials come off and now testing the 50-day moving average again after bouncing above it coming into this week. So it'll be interesting to see there, especially if you saw this as a move to new highs with unlimited upside, to recognize the fact that we've seen some weakness, saw a bearish divergence here. You're now seeing lower lows. We're now potentially seeing a lower high with the pullback today, and that short-term pattern more in that tactical time frame, certainly weaker rather than stronger. Healthcare is another one, and we've talked about occasionally. I think that was one of our 3 and 3 yesterday or the day before, looking at the XLV. And again, I think the relative strength as a sector is what's been challenging. If you look at particular groups like biotech, like pharma, like medical supplies, you'll find some opportunistic names within there for sure. It's all about a question of digging below the level, below that top level a little bit. Looking at our Scooter reports and what stocks are working, what stocks are not, a couple observations to be made here. I was digging into this a little earlier today. I couldn't help but notice that 3 of the top 10 names in our Scooter rankings, this is our large cap StockCharts technical rating, looking at a big list of large cap stocks and ranking them, essentially percentile ranking them based on their trend characteristics. And we have a Chart School article that outlines the details there. 3 of them are all within home builders. You have Lennar, D.R. Horton, Pulte Homes, all in the top 10. Tesla has been the number one for a little while here and remains in their top position. Automobiles as a group was the top group out of our 100 odd industry groups. So that has continued to be strength, but home builders have emerged and they've started to go further and further to the upside. A little later, we're going to have a segment called ETFs Engage. We're going to focus on some of the home builder ETFs and their characteristics and dig into that theme a little bit further. But that's where that sort of came from. FedEx remains one of the top names in the StockCharts technical rating. If you look at the trend overall has just been fairly consistently positive, and the trend in the relative strength, I think, is what's most impressive. So if you start the clock in mid-May, it did okay coming off of the March market low, but really mid-May to now is where a lot of relative performance has come from. And just look at that consistent uptrend. It completely ignored the September peak in many stocks, and just has continued on into the upside. Nvidia and some of the semiconductor names have certainly emerged, breaking above swing highs and emerging more on the upside, and certainly worth paying attention to. Netflix, we talked about the FANG trade and this potential rotation here. A lot of these stocks have pretty clear support levels to pay attention to. Netflix, as we looked at it earlier in the week, kind of coming back to that 50-day moving average, but really falling through to the upside today, up over 5.5%. So certainly be looking for those types of names that are they're able to rotate more on the positive side. And finally, only because I feel like I speak relatively negatively about financials, and I don't mean to completely shut down the whole concept, but it's more an observation of the relative strength. The relative strength warranted some recognition. I will make a point of doing so. And with that in mind, have to note Charles Schwab actually reclaiming its 200-day moving average, actually closed right about at the level. It's able to break above there and hold. That's actually a really meaningful rotation higher with relative strength that is starting to impress a little bit. So even within financials, which I think is one of the more weak sectors on a relative basis, there are certainly pockets of opportunity, and look for swing breakouts, look for breakouts above moving averages, and especially look for relative strength improvement as you're trying to identify some opportunities in those spaces. That is our market recap for today. I want to take a quick commercial break. We'll be back with my guest, Guy Cerundolo. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I want to thank you for joining us every weekday after the close for our show. As a reminder, we'll have another mailbag segment at the end of this week on Friday's show. We'd love to answer one of your questions on the air. So just shoot us an email, thefinalbar@StockCharts.com, or on Twitter @FinalBarSCTV, or on YouTube. Just put a comment below the video, and we'll capture those and hopefully answer one of your questions on the air tomorrow. I want to welcome on my guest to the show for the first time, Guy Cerundolo from Cerundolo Investment Research. I have known Guy for a number of years. When I lived in Boston, I used to enjoy very much catching up with guys like Guy, grabbing lunch and comparing notes about the market. So Guy, welcome to the show, and thanks for bringing some of that market wisdom with you today.
Thanks so much, Dave. Great to be with you. Yes, I do miss the lunches as well, but
someday the world will allow us to do it again. I will see you in Boston. But until then,
exactly.
You brought a part of the Nasdaq Composite with you, and we've talked about the overall conditions of the equity market. Obviously, coming off a peak in September, now seeing some short-term strength. Talk us through your perspective on Nasdaq here.
Sure. So the tools that I use are those where I can help find inflection points for managers that are trying to move, sizable amounts of money. And basically, what I'm looking at here, some of the proprietary tools that I use, one of which is called Money Flow Units, was developed by a gentleman years back. And what it does is help me identify what you mentioned earlier, gas in the tank, how much fuel is behind the impulsive move off of a low or off of a high. So back in March, April, that base pattern projected a high at 11,720, which is an MFU4 target. So into August, I was recommended to clients just to be careful as prices coming into a target zone. The thing is, we don't know the magnitude of the decline, but you know that you don't want to be pressing the gas pedal there and putting more capital at risk. So once we get the pullback, then what happens is we start to identify where there are support zones, and we use different tools such as ellipses and mobs, which are indicators of the software that I use, Advanced Get. I've been using it for well over 20 years. So when I combine that with my money flow units, I try to come up with zones, levels where things are lining up, where we could have either potential turn back up in this case, or breakdown and then we have a projection lower, which is the MFU2 at 96.20. Now that would only come into play if we start to see price decline below that mob band. So as it stands now, that is off the table. So I have to highlight what the potential downside is. But given that we got a double bottom at the mob, then you get price getting back above the lower end of the regression trend channel. And I use channels a lot in my work. I thought that was the first step in the right direction. And then the move in the last couple of days above the 50-day was really key as well. So I look at the retracement off of the high at 50%, so that level there would be key to close above, which I believe we just got today. I think that is setting the stage for the next leg, the higher, which is the MFU3 at 11900. Now that zone there, I'll be looking at closely and then highlighting to clients whether or not it's a potential pause zone, or if we break through it, then the MFU4 comes into play, similar to what we had back in September. So that'll be the next upside level. So as I stand now, some of the stocks that you mentioned, AMD, Apple, Qualcomm, they have that same look. And I think what this tells me is that there's enough flow coming and that these stocks are going to be a bit higher. So as it stands now, today's price action, I think, opens the door for that move up into that first zone of 11900, which is roughly 5% from here. So I like the price action in here, and I do think we have set the stage for a nice pop higher in the next couple of weeks. It may be weeks, maybe more than a few weeks in duration. Magnitude is one thing, but applying a time element is a different thing.
Sure.
And then in gold, I thought I'd highlight that because I write about gold a lot, and actually started to put bullish notes back in, I think it was the third week of December of last year. And so here too, the money flow work helps me identify big inflection points. But what caught my eye off of this decline that we had over the last couple of months is that zone where it says MFU4, that price target of the money flow work overlap with the mob band, which is a part of that software that I mentioned earlier. So when things line up like that, it really, really catches my eye. So that's a zone where aggressive traders can get long. And then I am looking for a push above 1920 to really put out notes more detailed, highlighting to people that are, really want to pound the pavement and get long gold in a big way. That's really the uncle point where we really have to press the gas, the gas and add much more to the long side. The one thing that I also thought about, what if this whole pullback was a bear trap, because we did take out that March low right to the left of the MFU3 arrow. Mm-hmm. So it looks like, it's a potential bear trap. We could possibly have shorts that are trapped in there. But again, getting above 1920, I think it's going to bode well. And from there, the longer term target should come into that 2180 area, which is well above the high of this past August. So I think this is the early stages of carving out another low, and again, press the long side once we get above that 1920 zone.
Guy, this is a welcome dose of optimism in terms of charts starting to set up for some further upside. But I like the read on the Nasdaq, and it looks like gold with some potential upside above 1920 being a key level. Guy Cerundolo, thank you so much for coming on the show. It's great to chat with you. Great to hear from you. Hope you and the family stay safe. All right. Thank
you, Dave. Bye.
That was Guy Cerundolo from Cerundolo Investment Research, based in Boston. Guy and I both former Fidelity team members at different times who have enjoyed getting to know Guy for many years and followed his work for a while. And it's really interesting to see actually some positive rotation with 1920, a level on gold. I jotted down. I'm certainly going to follow that. Our next segment is called ETFs Engage. What we like to do with some regularity is focus a little bit on the ETF space and think about what the construction of those are. We talk a lot about ETFs, and I've used ETFs for years. I remember when, in the early 2000s, when I was just getting in the industry in 2000, and, learning as ETFs became more and more widespread and recognizing the value of transparent pricing for all of these different things. And it started out with industries and, overall markets, but then got into currencies and commodities, and eventually there's an ETF for themes and everything else we can do, even active ETFs. And so I've it's always been a part of my process to some degree. But what I have found working, especially with a lot of financial advisors, the question number one is analyzing the ETFs from a trend following, technical perspective. But another really important piece of it is understanding what exactly you're getting exposure to and making sure that you're comfortable with that. And having said that, I wanted to point out a couple of the home construction or home builder ETFs. When I talk about home builders, I usually use one of these two ETFs. I'll use the ITB or the XHB, which are two of the commonly pretty liquid and pretty similar, if I remember right, in terms of assets and expenses. If I remember right, I think they're relatively similar. There might be some little differences, which you should certainly be familiar with before you would make any decision based on them. But similar construction, but the construction is actually similar idea, but the construction is actually a little different. We're going to start here. If you look at the industry groups which we use underneath consumer discretionary, there's a group called home construction, which is really the home builders, right? It's things like Lennar and D.R. Horton and Pulte and others that you're probably familiar with. These are the ones that I highlighted earlier that were in the top 10 list of our scooter rankings. We have a separate group called home improvement retail, and this is going to be things like building supply companies, Home Depot, Lowe's, and those sorts of things are all in there. So the reason why I point out those two is you can take these tickers. So if we look at the chart of the Dow Home Construction ETF, this is a price-weighted index using the members of that group. So if you look at the industry summary page, if you click on home construction, you can see what's actually in there. And again, if you look by market cap, you can see some of these different ones, but these are the names you're probably familiar with, and include some small cap names, of course, as well. So that's the performance of the index, and you can see it's actually making a new 52-week high today, right up over just over 2% to close there. Now, having said that, there are a couple other ETFs to point out. ITB is this one. This is the iShares Home Construction ETF. It actually is relatively similar to the industry group that I just showed you. So this is an ETF that's essentially a pure play on the home builder theme. If you look at the scooter rankings, it's ranked 99.2 out of 100, right? So it's a percentile ranking on all the ETFs. So it's all ETFs put in a big basket. So it's sectors, styles, themes, global stocks, other ETFs sort of all in one pile. These are, ranking them in terms of trend characteristics. So it's in the top 1% of ETFs out there. What's interesting about the home builder ETF ITB is the fact that it's rallied beautifully. It had this nice sort of basing pattern. We can see this consistent resistance level. It's just closing to a new 52-week high today, up almost 2%. And I also like the move right off of the 50-day moving average. So while the S&P is kind of floundering around the 50-day, and it's a question of where, if it's going to reclaim it, if it's going to follow through to the upside or not, you have in the home construction ETF a pretty much consistent relative outperformer since mid-March, continuing to make price highs and now relative highs as well. So overall, it's been pretty impressive. The other one is XHB. Now, the pattern is going to be relatively similar because they have a lot of the same members, but you can see that the relative strength is not as good, even though it's been going up. If you look at the number, looking at the last year, the ITP is up about 15% relative to the S&P. The XHB, this other one that I'm showing you, is up only about 8.5%. This is the S&P Spiders Home Builders ETF. And of course, it's a horrible naming mechanism because it's actually called the Home Builder ETF, but it includes those home construction names, building supply names, and everything. So things like Home Depot and Lowe's are in this ETF. So don't read too much into the naming of the ETF and make too much of an assumption about what it represents. Always do your due diligence and look underneath the hood, just like I would expect, just like you would hopefully look at expense ratios and spreads and liquidity and all those sorts of things. Also look at the constituents and see what sort of exposure you're going to get. Now, having said that, all of these are setting up pretty well, and again, because they're dominated by the home builders, which have done very well. Here with the XHB, you can see a similar pattern where it's bounced off of the 50-day moving average. It's testing resistance and making a new 52-week closing high. Same idea, up about a 1.5% today, which is good, and making new relative highs for the last year this week as well. So all of that is relatively constructive. But again, even though the lines are both going up, if you compare them together, you'll notice that the ITB has done better. And it brings to mind Gaddis Rose's work, who does a really good job of using the perf charts on StockCharts.com to actually chart different ETFs like this, the Home Builder Index, the XHB, the ITB, whatever other ways in an active fund, for example, a mutual fund, putting all those things instruments you could use to get exposure to home builders, and then actually seeing what's been able to perform well based on the construction and fees and whatever else you want to throw in the mix. And so it's a great reminder for that. Now, again, just to finish up, some of the stocks that make up these ETFs have done very, very well. And Lennar, Pulte, others, DR Horton are in the top 10. And this is why the price looks very similar. It's been in a nice, consistent uptrend. They've all sort of had this basing pattern, and this pullback where it made a bit of a shorter, a lower low of sorts on this tactical time frame. I remember looking at these charts and thinking, okay, this might be the beginning of something breaking down, but the 50-day is something I'd certainly want to look at. If you look, they've all kind of bounced very nicely off of there now, rotated back to making new highs, new relative highs as well. So as we look at some of these other names, you're going to see pretty similar patterns and nice overall decent setups. Those are the three that are in the top 10 list. So in conclusion, in the segment ETFs Engage, I hope my main takeaway is definitely be aware of the exposure that you're going to get with any ETF, and don't just rely on the ticker, the title of the ETF, the label as being a good definition of what might actually be included. Within home builders, those are the couple more liquid ones. You have ITB as a pure play on the home builder theme, XHB, which includes some other building supply companies and others that are sort of in the mix, but all of them setting up fairly in a fairly constructive way, making new price and relative highs. We need to wrap the show, go to the 3 and 3. I do want to just start this very quickly by pointing out, I apologies to my friend John Kopp. I spoke with him yesterday, earlier in the week on the show. I mentioned his ETF and completely blanked on the air what the name of it was. It's tradingfromthebeach.com. And he had a great article recently about using bullish percent charts, which we talked about recently about the bullish percent index. So it's well worth a read if you haven't seen John's work before. Let's get to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the S&P with new highs and new lows. And we're just looking at the last 3 months to focus in on what's happening here. We talked about home builders just now making new 52-week highs, and a number of them are starting to do so. And those are the types of stocks that are reflected in this list. At the bottom, it's the number of S&P stocks making a new 52-week high. In red would be stocks making new 52-week lows. You can see recently, literally 0 members of the S&P making a new 52-week low, which makes sense. That's pretty far away from most charts because they topped in February. They bottomed out pretty low in March, and they're sort of in the range. For me to feel good about guys, anticipated further upside, which certainly is a potential scenario here, I would definitely want to see this line improve and look a little bit more like it did in July. If you saw the congestion we had in June, the move to new highs, you can saw that the new high number in the S&P 500 started to increase, and we really haven't seen that yet. So I would want to see that improve before I got too optimistic about the potential for further upside. In terms of positioning, Thursday is usually a big sentiment day. We had the AAII readings that came out earlier today. The name exposure index also coming out in the last 24 hours, and remaining relatively muted, down just below 60%. So since the sell-off that we had about a month ago, the overall positioning, and this is with active money managers, what's your exposure to the equity markets, still not overwhelmingly in there, which implies that, if you're thinking about gas left in the tank, that certainly implies that there may be some more left there. And you notice maybe on that last chart, the extreme high reading you had on that going into the high at the beginning of September. Finally, as I mentioned, home builders are just one group that came out of my review looking at the scooter rankings, what groups are doing well, what stocks are doing well. And I think a regular review of those scooter reports can be really helpful for understanding what's working and what isn't. And I'd point out with the ITB, the XHB, any of those home builder ETFs, they're all holding up very well. And on a relative basis, that's what is most encouraging to me. Tom Bowley says, if you want to outperform the S&P 500, you need to own stocks that are outperforming the S&P 500. All else being equal, I'd want to own charts where the relative strength line is going up. That is our show for today. Thanks so much for joining us every weekday for the Final Bar. A special thank you to Guy Cerundolo from Cerundolo Investment Research for giving us some thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.